And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. It's, of course, the second best day of the week as we get ready to wrap up the middle of November already. This year has just gone by so incredibly fast. And that also means that Christmas is right around the corner. So if you haven't started shopping yet, Black Friday started 3 weeks ago. So, get out there and do your thing. Amazon's counting on you to do your shopping this year. But interestingly enough, credit card debt, consumer delinquencies that are now 90 days or more is at the highest level that we've seen in over a decade. So despite the fact that we keep hearing all this kind of really, not strong economic data, right? Unemployment's low, economic growth is at 3%. Look, there's certainly some financial trouble with the average American consumer, and those getting further and further behind on credit card debt, starting to kind of pile up. Now, again, that doesn't mean anything necessarily, but it just certainly goes to show that consumers are a bit under stress a bit here as we start heading, into the biggest shopping season of the year coming up. Of course, this is going to be very big for retailers. Next week, we're going to hear from Walmart, which will be interesting because we've seen a stepping down of consumers from higher end stores down to, say, Walmart as an example. They've been a beneficiary of this kind of step down, which is also interesting because I posted this tweet out yesterday on Twitter, and it was a survey asking people what they would do if an item got too expensive for them. And so it gave a list of choices, And, the number one choice was, I just won't buy it. Second choice is I'll find a cheaper version of it than what I was going to buy. I'll just buy a different version. Or I will substitute something else in its place if I just need to have something. And that's a very important survey because this is the whole fallacy of tariffs will cause higher inflation in the economy. Because that's how consumers are. If you raise the price of some good, I put a tariff on China, products coming in from China, people go, oh, too expensive, I'm going to buy it from somewhere else. I'll buy something cheaper elsewhere. So again, it's a very good, recognition of how and this is the one thing that economists tend to overlook is the consumer reaction. And this is a big problem with economics in general. This, like we found out with modern monetary theory. Economists were like, oh, modern monetary theory is great. We send people money. They have more money to spend. They don't have to work as hard, so they can go improve their life and do all these other things. And they'll pay off their debt and they'll save money and it'll be great. They don't understand how consumers work. So as soon as you sent them money, what they do, they ran out and spent a whole bunch of it. So, it created, which obviously created inflation. So, this whole idea of how economists think is very backwards because they think about consumers being rational beings and they're not rational. They're more impulsive than anything else. But when it comes to higher prices, they do find ways to substitute other measures. But again, even when they're running out of money, they'll go into credit card debt, but there's a limit to that as well. And we're now starting to see some of those limits which are deflationary longer term. And so we're going to keep watching that. We'll talk a little bit about inflation this morning because we had CPI out yesterday. Michael Lebowitz is here this morning. We've got PCE out this morning, which is the Fed's preferred measure. So we'll take a look at both of those. Just discuss a little bit about this morning and what the Fed's likely to do after yesterday's report. There were also some interesting, kind of reactions to the CPI report yesterday that really are kind of debatable. So we'll talk about that with Michael Lebowitz this morning. But here's what you need to know before the bell this morning. Market yesterday had actually sold off kind of earlier in the day and then rallied back to just a little bit into positive territory, but basically just holding up here at a very high level. Participants right now just not willing to sell. That's really kind of where we are. They're not really buying as much. We're starting to see volume drop here a bit on kind of the VWAP basis, the volume weighted average price. And, so we're not seeing a lot of demand for stocks, but sellers just aren't willing to sell here either because they're expecting this market to continue to rise into year end. Analysts are getting very exuberant with their outlooks for year end. As I said yesterday, I put out a poll on Twitter. 50% of people are like, oh yeah, it should be 6,200 by the end of the year. Shouldn't be a problem. So we're starting to see a lot more exuberance in the market. Bitcoin, of course, is the interesting one. Since the election, Bitcoin has just absolutely kind of just melted higher here, currently trading around 91,000 this morning. So we just had a very, very sharp speculative run. And this is the beauty of Bitcoin, which is the best speculative investment, kind of measure of risk. If you want to take on pure risk, Bitcoin is that measure. And it's has just melted up here over the last few trading days, which is great, right? So I own Bitcoin, so it's been going up. It's great. But again, extremely overbought now. Very extended. We're going to talk a little bit about MACD this morning with Mike. He just wrote an article on this, but the MACD is very, very extended. So strong, really strong momentum here, but extremely overbought right here. But again, Bitcoin can remain overbought much longer than you think. Now, conversely, gold has just absolutely gotten hit hard here, really since the election. Gold's trading down another 80 basis points this morning. Cracked the 20-day, cracked the 50-day, testing the 100-day. We're going to threaten to break that 100-day moving average today. If we do, that's going to set gold up for about 2,400 on a pullback. But we had talked about this before. As with Bitcoin is now, gold was extremely overbought. And we talked about this on the show a few times, like, hey, on a monthly chart, you've only been this overbought about 3 times historically, and you normally get a decent correction following such big monthly overbought conditions. Big sell signal here, momentum actually drying up fairly sharply here. Again, you're getting pretty oversold on gold, so I would expect a bounce probably back up to around 2650, where the 50-day moving average is on gold, and that's probably going to be a decent opportunity to take some profits, rebalance your risk in your portfolios, particularly if you've got a lot of weight in it. You've definitely kind of broken the previous trend right now. So again, just kind of keep a watch on that. Excuse me. Lastly, I got a tickle in my throat this morning. Lastly, IWM, this is the Russell 2000. Post the election, there was a lot of exuberance about small cap, mid cap stocks, of course, coming out of the election, deregulation, lower taxes, etc. Saw a very, very big pop in small cap stocks. Again, kind of like Bitcoin, extremely overbought, working off now some of that overbought condition. Expect small mid caps here to pull back to around 226, 227 probably. Test that 20-day moving average. That'll be a decent entry point to add a little bit of exposure potentially going into next year. If the expectation is that we're going to see the Fed continue to cut rates, that you're going to see better economic growth. Bank lending standards since the election have loosened up sharply. So banks are very confident right now with the Fed cutting rates, and now with the new administration that's very pro-business friendly. Those business lending conditions are starting to loosen up. That's going to be helpful for small to mid-cap companies. We should also see a very big explosion, as I said before, in the NFIB index, which will also be very supportive for small mid-cap stocks. So again, look for a pullback there to add to your position or to build a position. Again, overbought here short term, but this is really kind of the message of the markets is it's been all risk on. So everything that was a safety trade, bonds, gold, etc., that's been sold. Everything's into full-on risk right now in the markets, and that's probably going to stay the case here at least for another couple of weeks. So we'll just kind of continue to measure this. But understand, markets are really overbought. You're going to have a pause here. So don't forget, rebalance your risk, manage your portfolio accordingly, and you'll be fine. But that's what you need to know before the bell this morning. All right, when we come back, we'll pick up with Michael Lebowitz. We'll talk about an inflation report yesterday. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partner to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. It's, of course, Thursday. Michael Lebowitz joining me a bit this morning. If you're on our YouTube channel, we certainly appreciate it right now. If you're hanging out with us, be sure and like and subscribe to the channel. That certainly helps us a lot with the algorithms. Also, Brent has kindly posted the rules for chat. Stay on topic, be polite, no trolling. That does not apply to me. Those rules, this is my house. You want to play in my house, you follow the rules, but the rules don't apply to me, so I will troll you. So just be fair. Be aware, you're fair game. But no, seriously, I'll be nice, be polite. Always happy to interact with you. And if y'all will stay on topic more, we'll be able to interact with you more. But when y'all go off on these tangents that y'all do, it's hard to interact with you. So there you go. All right. So, Michael joining me this morning. Let's talk a little bit about CPI yesterday. PCE out this morning. Of course, as I said, that's kind of the Fed's preferred measure. I posted a table out yesterday on Twitter of the last 5 months of CPI by segment and weight. And, you know, what was interesting is that the vast majority of CPI is actually declining, and there was only a couple of little outliers that showed an increase. The interesting one, of course, is the biggest weight in the index, which was the homeowners equivalent rent went up a little bit. It's still lower than it was 4 months ago, but it went up a little bit, and everybody was kind of focused on that. It's like, oh my gosh, rent inflation's coming back. There's a lot of problems with that homeowners equivalent rent, because if you look at any other real-time rent index, there is no rent inflation. It's actually declining. So, why is homeowners equivalent rent so detached from what we see in real-time data everywhere else in the country? Mike.
So,
I figured the pregnant pause was the cue, but there you go.
It wasn't a great cue. You've done better, Lance. So CPI is a tricky number. We've talked about this. 40% of it is shelter. And shelter really has two big aspects to it. One is rent. So it's literally what people are being charged for rent. But a bigger part of it is implied rent, or basically what they do is they call people, what could you rent your house for, or a room in your house, or, whatever it may be. And it's imputed from the surveys. It's also imputed from house prices. And they get very quirky data. The data tends to be good, but it tends to lag significantly. Mm-hmm. And there's, the other thing that goes on is they call you and they ask you what you're paying for rent. And you have likely locked into a rent for a year, 18 months, maybe 2 years, maybe even longer. So the last time you negotiated your rent could have been 18 months ago. So they say, hey, what are you paying for rent? Oh, I pay $1,000 a month. Well, first of all, you got a great deal if you're only paying $1,000, but that number could be 18 months old. It could be 2 years old. And everything else, orange juice, computers, TVs, cars, how did the price change from last month to this month? That's what they're doing. But for some reason with rents, they're not looking at the monthly change. So just give me rents of people that have just signed on a dotted line the last few weeks.
Right.
And the funny part is I don't know if it's the BLS, but some arm of government that the Fed acknowledges, I think it is the BLS, who puts out CPI, also puts out, I think it's called asking rents. Mm-hmm. And those too are zero or near zero. Right. As is Redfin, as is Zillow, and other apartmentrent.com. There's like 4 or 5 of them that are all telling you rents, give or take, zero. Right. So 40% of CPI is zero. Now you do the math and you look at CPI, it's running at 2%. And it's been running at 2%, which is the Fed's target. Mm-hmm. Doesn't mean there aren't items that are going up, that are high, that are too high, that are sticky at high levels. But again, if shelter was kind of doing what's going on in the real world, CPI would be at the Fed's target. And I think the outlook for what the Fed is going to do would probably be a lot more clear.
Yeah. Well, and again, one of the, I can give you a real-time example of the problem with rent. So, if you've listened to the show for any length of time, you know that I sold my house that I lived out when I lived out in Katy. I sold my house about coming up on 2.5 years ago, and so we sold our house. And we rented a house for 2 years. So we signed a 24-month contract with our landlord for this house, and we rented it for 2 years. And so we paid the same rent for 2 years. So our rent did not change for 2 years. So we moved out in August, right at the end of August was our last rent payment to him. And he re-rented the house in early October. So he had about a month lag that the house didn't rent. Well, he tried to raise the rent by about 25%. He wound up leasing the house for less money than what I was paying in rent. So, so over 3 years, and this is in a part of town that maintains its value very, very well. But over 3 years, the rent did not go up for him, right? He collected no more rent. So, but what is interesting is that the house value in that neighborhood went up. And this is what I think is one of the problems with the imputed rent that they're collecting. So first of all, if I'm a homeowner and you call me right now and ask me, Lance, you just moved into your house, how much can you rent it for? Well, I think the value of my house is more than it's probably worth because of what we did to the house. The house is very, very nice, and I'm really proud of it. But I think I think the house, I won't sell the house for what the house would actually sell for, right? So I just think my house is worth more. So, if somebody asks me what to rent, I'm going to look at what I've got invested in my house right now and go, I need $7,000 a month. I'll pick a number, right? I need $7,000 a month to make this make sense. And so, there's been so few transactions in houses over the last couple of years. We're seeing home prices still go up because there's so few transactions to get a house sold. People are having to pay more for it and to get that house purchased. And so I think a lot of homeowners are looking, when they're asked that question, what would you rent their house for? They go, yeah, my house price is still doing well here. So, I think I should be able to get, $5,000, $6,000, $7,000, $8,000 a month, whatever the number is. And so I think there's a big skew between what people think they can get for rent and what you can actually get for rent, which are two very different things. And again, I have real-time examples of both because I know what he just rented that house for that I was paying for 2 years, right? And so I think there's this big difference that doesn't get calculated into that 44% of CPI that is probably not realistic. Again, we start looking at what real rents are doing.
And
Mike,
Lance,
it's
the
your
other
turn
part
now.
of that,
you speak.
My turn. So the other part of that is the way they impute prices from house prices. You know what? For the first time in a while, I feel I don't really know what my house is worth. Like I used to have a good feel for it because there were a lot of houses, some similar to mine, some different, but within my little town in Maryland, that were selling all the time. So I could see what they were worth. Oh, that one had an addition. That one hasn't been touched in 50 years. And, you could you could form judgments. And my guess is that I was always probably within 5% of being approximately what my house was worth. I have no idea. In fact, my neighbor's house just sold a few months ago, and I was off decently from, and it actually went below what I thought it would come at.
Interesting.
So then if you say, okay, well, if your rent should be, X percent or part of your mortgage payment or whatever, your basis for your foundation for coming up with what that rent should be, if they ask you, is skewed. And, even if you think you can rent your place for $7,000, Lance, you have no idea what the rental market is for houses in a neighborhood full of owners. It's not like an apartment building where there's 300 apartments that are all identical. There's a 1-bedroom, a 2-bedroom, and a 3-bedroom, but they all have very similar layouts and they all look alike. That's very easy to tell you what the rent is. But houses are very unique. Lance, your house has a studio. I, as a renter, may say, that's really nice, but I'm not paying up for a studio.
Exactly.
I don't want the pool. I have little kids. That pool may have a lot of value to you, but it doesn't have any to me.
Right.
So, everyone wants different things, and, trying to calculate what you think you could rent your house for.
Well, and that's kind
beyond.
of it's my point. I have no idea. I just threw out, $7,000. I have no idea what the house would actually rent for, or because I have no intention to rent it. I think that's, if you call somebody with no intention to rent, like Mike, I call you up today, you're not leaving your house until your wife dies because she's
until
not going
she tells me.
Yeah, exactly. Y'all are not leaving that house. But so if I call you up today and say, hey, Mike, what can you rent your house for? Like you said, you really don't know, and you just kind of make up a number. Right. and
right.
Well, I heard that so-and-so was leasing his house for X. So, that's what I'm going to lease it for.
Honestly, my number would come off my mortgage payment. I know I have this nut to make every month. And so I'll take that and I'll add X to it. And that would be my number. And it's not a rational number.
Right. And that's kind of the point. But, again, it's just, we're seeing a lot of this data that is kind of getting that, when we're talking about inflation, apparel as a good example, which is another 15% of the index, had a huge drop. So if apparel's dropping sharply, which says that consumers are, and this goes back to the credit card delinquency rate, if consumers are starting to pull back from shopping for apparel, particularly as we go into a Christmas shopping season, and we're seeing big price drops in apparel, that may tell you more about what's actually happening in the economy than these estimates about what rent is. So again, it's a big number. It's in flux. We'll talk about PC when we come back because that's going to be today's number, and what this all means for the Fed. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Did I tell you I got off good this year for Christmas?
How'd you swing that?
She told me what she wants for Christmas. I'm like, I am all in on this.
The Real Investment Show podcast.
A wet dry vac for our back porch.
Wow.
That's what she wants.
That is fantastic.
I know. I was like, yes, I can do this.
Same show, your schedule.
Hey, can I throw in some floor mats too for the car?
Let me tell you, she would be thrilled with that.
That's fantastic.
She is.
At realinvestmentadvice.com.
She's a geek. I love her to death. I'm getting off good this year.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just talking a little bit about CPI and again, just, the big thing about CPI is just take it with a grain of salt, because there is no good universal measure of inflation, period. As we've said before, the way CPI is calculated, it's very manipulated due to mathematical adjustments, etc. Also, it doesn't really attach to any personal measure of inflation. We've talked about before, Mike's measure of inflation where he lives is very different than the inflation where I live, which is very different than the inflation in California. Right? So you don't read a whole lot into it. The only reason we talk about CPI is because it's what the market looks at. The market reacts to that. The bond market, the stock market, et cetera, all reacts to those CPI numbers, which were in line yesterday. By the way, regardless of the impact of homeowners equivalent rent rising just a tad, the rest of the vast majority of the other indicators were all down. And so the CPI report came in line on both the headline and the core with expectations. At the current rate, if we keep the current rate of inflation going, the way it is, if we do 0.2 in November, 0.2 in December, 0.2 in January, 0.2 in February, if we keep meeting what that inflation rate is, inflation will fall to 1.9% at the headline in April. So just because of year-over-year comparison. So again, just got to keep all this in mind. But PCE out today, Mike.
PPI.
Sorry, I said PC. PPI was out today. It is coming out today at 7:30. Fed's going to be looking at that also. Another expectation, probably it comes in line with current estimates. But what does this all mean for the Fed? The Fed's got another meeting coming up in December. And, they're obviously looking at this data. They don't look at CPI that heavily. They're more focused on PCE. But, what do you think any of this means for the Fed, and kind of does it change their outlook for potential rate cuts going into 2025?
The data goes along with everything they're doing and saying. I think what the Fed is grappling with is more marketing. Like, we want to get rates down, but how do we do it without upsetting the bond market? How do we do it without getting concerns about inflation to start rising again? What about inflation expectations? And this is something I'm actually going to put in a commentary over the next day or two that we didn't talk about. During his press conference, Powell talked about inflation expectations. Someone asked him a question and how important they are. So it's not just inflation, it's inflation expectations. So if I think prices are going to be a lot higher, and actually this goes back to tariffs, Lance, when people expect a tariff to come, so if Trump comes out today and he says, I'm going to put a 100% tariff on all Apple computers, Apple sales are going to go through the roof right before that tariff goes into effect.
Right.
So, kind of lost my point here, but inflation expectations are really what matters to the Fed. And in particular, he told us that they use what's called the 5x5. Sounds like an exercise workout, but it's not. It's basically what it is what's inflation, what's the 5-year rate of inflation 5 years from now? So if I tell you what the 5-year expected rate of inflation is and the 10-year rate of inflation is, you can back into what you need over the second 5 years to make that 5-year inflation average out to be what the 10-year inflation is. It's not as complicated as it sounds, but that's what the Fed uses. And that gauge, along with much shorter 1 and 2 and 3-year inflation expectations, aren't budging. They're basically back to where they were before the pandemic. So the Fed has to deal with the CPI rent issue that we're talking about, and the Fed is probably saying behind closed doors, look, CPI is at our target. What does the market want from us? And and inflation expectations, which are more or less back to their target, and rates that are well above where they should be given the economic growth rate and given the inflation growth rate. But if we screwed up 2 months ago, we went 50, we probably should have gone 25. Now everyone thinks this is the 1970s rate, inflation's going back up to 10%. And, we're kind of on this inflation treadmill at this point. So the Fed, I think, is just trying to figure out, well, what do we do? Do we just, even though we want to cut, do we just not cut so we look more hawkish? Or do we cut by 25 and say this may be it for a little while? So I think it's more the marketing and how they try to wordsmith, to try to calm the market, calm the inflation worriers down, and try to calm the bond market down. So I think that's their bigger task.
Right, and again, this is this is kind of big. We've seen a lot of gyrations in the bond market. Really, just going into the election, there was a lot of hedging for the election, and the bond market coming out of the election, there was a lot of de-hedging, and we saw bond yields fall really sharply, and then they've reversed over the last couple of days because of the inflation worry. So, they've just been all over the place. They haven't really gone anywhere in the last couple of weeks, but they've just been up and down, up and down, up and down, which is, providing a lot of volatility to the overall bond market. It's not really, but interestingly enough, it's when you take a look at the term premium on yield on bonds and look at the valuations in the stock market, historically, when you have term premiums about where they are, you're going through a very decent valuation correction. But so far, yields haven't really seemed to impact the market yet. And I think yet is the key word there. So, there's a lot of optimism since the Trump election about stocks, the outlook. But there's a tremendous amount of potential headwinds coming, as we've talked about over the last couple of days, with doing drastic policy changes or trying to reform government, so to speak. There's a lot of risk to the economy as well as to market impacts that the market may be overlooking. Plus, you add to that these higher yields, which are going to weigh on profitability for companies, particularly in the small and mid-cap space, who have to deal with those higher yields, not to mention you got a lot of debt refinancing come up. So there's a lot of risk going into 2025 if yields stay too high for too long.
And it seems like the markets are only listening to what they want to hear from Donald Trump.
Right.
What did he say the other day? That Team Doji, Elon Musk and Vivek Ramaswamy, are going to cut, what did he say, $2 trillion from the deficit? Some number that's not going to be cut from the deficit.
Right.
He's telling you that we're going to end the wars in Israel and Russia. That would save us a lot of money. We're funding both of those wars to some degree. So there are things out there that will reduce the federal deficit. And when you ask people why are yields going up, it's usually inflation, but some people tell you, because the government's spending like drunken sailors. Trump's telling you that they're getting rid of the drunken sailors. Whether he does that or not, we don't know. But a lot of what is being proposed right now is not necessarily inflationary. And
the other side of it is that government spending has made up a huge chunk of economic growth over the last several years. So if you start whacking off on the deficit and the debt, you're going to be in a recession pretty quick.
Right. And you were talking about tariffs earlier.
Yeah.
My article next week is all about tariffs. And there's nothing inflationary. They're inflationary, right? If they tariff the price of Apple computers, the price of Apple computers will go up. Yes, there'll be inflation for Apple computers. But you have to look at everything in aggregate. This is CPI. This isn't, inflation rate isn't the price of one type of computer.
Right.
And when you do that, and when you think about how it affects the economy and you put it all back together again, tariffs tend to be just like all government interference. Government interference weighs on economic growth. This too, tariffs are just a form of government interference, whether it's us doing it or someone else doing it. And they tend to be negative for growth and deflationary.
Right.
So,
well, again, and then you also get you don't get to issue tariffs in isolation. You issue a tariff, you're going to get a retaliatory tariff, which causes all other kinds of problems. So, again, this is, and the point is there's a lot of risk that I think investors are overlooking going into 2025. I'm still bullish on the markets. Don't get Mike or I wrong. We're not, talking about, hey, we're about to have this massive market crash. We're very bullish into year end. There's a lot of reasons why markets will go higher into year end. But I think when you get into 2025, there's a lot of optimism right now around Trump policies. And a lot of them are great, right? I mean, a lot of these policies are going to be really, really good long term. But the point is that you don't get to make drastic governmental changes without an economic impact. They don't live in isolation of each other. I can't just go in and start whacking government employment and chopping off the deficit and just stop government spending, because there's a huge flow of that money that gets into the economy and supports economic growth. So again, it's just, you've got to keep that into some perspective when you're going into an environment with already elevated interest rates and high levels of debt and peak valuations. So you've got some real challenges going into next year that I think that we're going to have to really pay a lot of attention to, which is why when we come back from the break, we're going to talk about Mike's latest article. He just wrote an article. It's on the website. By the way, we just launched a new website today, realinvestmentadvice.com. We've moved some things around. So all of our blogs, newsletter, everything are under the resources tab at the top. But everything's there. Everything's still there. So you're not going to miss anything. But Mike's new article is out this morning talking about the MACD. And so we'll come back and talk about that and what that means as a way to kind of pay attention to what's happening in the markets in case something unexpected happens as we get into next year. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So Mike just wrote an article. We talked about technical analysis here recently on the show. We did a whole show just kind of going through very basic technical analysis. That video, we clipped it down, we put it on our YouTube channel. So if you actually go to our YouTube channel at The Real Investment Show, that's pinned. It's one of the pinned videos at the top, but we went through about 40 minutes of just kind of talking about various technical indicators and just how we use it. And I got a chat question this morning. It says, is there a Mount Rushmore or top 5 set of indicators that you can use for basic technical analysis? And the answer to that is yes. However, there's a big caveat to that. For instance, if you ask me, kind of my top 5 is the MACD, relative strength, RSI, relative strength index, the MACD, which is the moving average convergence divergence indicator, what Mike's about to talk about, Williams percent R, stochastics, and moving averages. Those are kind of my 5. But you ask somebody else, like I asked Mike, he may have, price momentum oscillator as one of his 5. Everybody does technical analysis a little bit different. People that do candlestick analysis does it differently than people that do Elliott wave analysis. So again, there's, this is what we were talking about in that show, is that technical analysis is a very personal thing. So however you approach technical analysis is fine, right? Find some indicators, find 5 indicators that you can use, that you understand, that will confirm each other. Because what you're looking for, and again, this is why we keep our technical analysis very simple, is that we just are looking for indicators to confirm that a price move is occurring in the direction that we want it to go, either up or down. So we want, an indicator to give us a buy signal, and then a couple of other indicators to confirm that buy signal is valid, and then we're good to increase exposure, and vice versa, right? So those are the things. MACD is a really good momentum indicator. What moving average convergence and divergence tells you, and I won't steal any Mike's thunder, but it's a great momentum indicator. It tells you what's really going on in the markets. So Mike, I'll just turn it over to you right there to talk about the MACD and why we like it and why we use it so much in our methodology.
Yeah, and it's also important to caveat this whole thing with some technical indicators work much better with some stocks or bonds or gold or whatever the asset is, and not well with others. Mm-hmm. So it's also important that you understand that MACD may be a great tool for the S&P 500, but doesn't tell you much with gold or certain types of stocks. So it's not just to have your kind of Mount Rushmore, but to appreciate where they're strong and where they're weak, and also looking at them over time. So the daily MACD, which I'll just go through briefly in a second, can tell you something very different than a weekly or monthly. And there's messages in all 3 of those. And it's using the MACD in conjunction with other indicators and patterns too. Not just, trend lines and, things like head and shoulders pattern and wedges that really kind of help you get a feel for what the behavior of the market is and where it may be going. So the MACD is probably the one we talk about the most, both, in podcasts and articles and behind closed doors. But again, we use it in conjunction. We also have one that we put on Simplivisor that is an oscillator, but it's one that we created. So, you can create your own indices as well. And all the MACD really is you are basically kind of having fun with moving averages. The daily MACD, the way it's most often used or created, is you take the 12-day moving average and you subtract it from the 26-day moving average, and that's your MACD. It basically tells you what's been going on in the most recent period, 12 days, versus a slightly longer period. And then with that, you kind of get a line that tends to oscillate up and down. When the market is in a trend, it tends to be above or below 0 and oscillates above, kind of, you're in a bullish trend, you oscillate, but you really get down to about 0, and then you tend to start popping up. Not always true, but that tends to be the way it works. And in a bearish market, you tend to be below 0 more often than not. Then you can also add to it what's called a signal, and it's just the 9-day moving average of the MACD. So again, we're just kind of, playing around with moving averages to detect momentum. How, is the rate of strength of the last 12 days greater than the last 26 days? Is that increasing or decreasing? So it's a great tool because you get momentum and you get trend analysis. How good is the trend? Is the trend lasting? But it's, the problem with it and all technical signals is, especially, more so on a daily. When you start going out to weekly, monthly, you get better signals, but they're delayed. The problem with the daily is you get a lot of false signals. We've seen the S&P 500 has given off a bunch of buy and sell signals consecutively over the last few months, as it's just kind of the MACD and its signal just keep crossing each other. It's telling you that momentum is growing stronger, it's weakening, it's kind of waning back and forth, but it's not, the trend is still intact, just that strength of the trend is kind of fading at some points, at other points getting a little stronger. So, it's a great tool and we really use it a lot, but it's not the end all be all by any stretch. And again, I like to, it's very helpful. And we were talking about Walmart the other day to compare the daily to the weekly, monthly, and sometimes you get two different pictures. So it may help you set up your risk. Where do I put a stop loss? How much more does this little rally have to run? Because we're starting to get very overbought, and there are signs that the overall trend for a stock may change. That change may not happen for 3 or 4 months, but it's something to think about and put on our radar. And the daily MACD may bounce around, give you 2 or 3 more buy or sell signals before that point, but it's something to be careful of and look for in the daily MACD.
Yeah, and again, on Simple Advisor, for instance, we have a weekly chart that uses 2 weekly MACDs. It's a very slow-moving chart, and a good way just to kind of state what you're saying is that on a daily basis, the MACD can give you multiple buy and sells, and I get this question a lot. Is I'll say, hey, look, market's very overbought. We've got a short-term sell signal. Take risk, manage your portfolio accordingly. Look for a little bit of a pullback or consolidation. But at the same time, you can be on a weekly buy signal, and so that's confusing people. Well, I don't understand. How can you be on a weekly buy but on a daily sell? And why are you saying if we're on a weekly buy in a bull market, why are we talking about taking profits and rebalancing risk in the short term? And that's because markets can move up and down. We can have these 5 to 10% corrections within a market in any given year. We want to try to navigate, try to manage some of that downside risk so we don't make emotional mistakes. But what the weekly or the monthly trend will tell you is, are you in a bullish trend or are you in a bearish trend? And so as a good example, right now, the S&P is on a very elevated weekly MACD chart. It's one of the highest levels we've seen since 2021. The last time we were here was in 2021, and we were warning in late 2021 is like, hey, we're very overbought here. We're going to have a correction of decent size at some point here. And shortly in late December, early January, we triggered a weekly MACD sell signal and then and we reduced our risk in our portfolio, and we had about a 20% decline in the markets, in 2022. Got the buy signal back in October of 2022, and that's where we started putting weight back into our portfolio, because now we're back onto a more bullishly trending market. And so we saw these things occur, and that's what so you can have these 2 different measures that can tell you, A, the bull market is fine, and right now the bull market is fine because we're on a weekly buy signal, but on a daily basis, super overbought. And we could see a bit of a short-term correction or consolidation because we're so overbought here, particularly as we get into the first couple of weeks of December. So, this is where it gets confusing. And again, all we're trying to do is just mitigate some risk in portfolios so we don't, give up a lot of the gain that we've made and stuff by just, watching it kind of evaporate, then go back to where it was and go back down and just try to avoid some of that volatility where we make emotionally bad mistakes in our portfolio.
And here's the other thing, Lance, that is very helpful to me, at least, and I'm sure you, is that the idea to write this article came from a question. It's like you guys talk about the MACD all the time. What is it? How do I use it? That type of thing.
Right.
Send us questions, because Lance and I are writing all the time. We have a daily we're writing every day, whether it's long form blog posts or the daily commentary, which are the shorter articles. And we need all the help we can get coming up with ideas and, to write about. I feel like once we have an idea and an outline, the writing isn't so hard, but it's coming up with ideas that we're constantly under pressure to come up with. So any ideas you guys have on articles, we would greatly appreciate.
Yep. Plus, Mike and I are generally just scratching around trying to come up with an idea to write for an article. So,
right.
And so your idea, the email questions are always great. So send us emails. Always happy to do it. You can go to the website, send us your question, comment right off our new website, which is up today, realinvestmentadvice.com. Appreciate you joining the show this morning. Brent and Danny are both out of town tomorrow, so tomorrow's show is live on Memorex. Be back on Monday with the next live show right here on our YouTube channel. So have a great weekend. Enjoy yourself. We'll see you back here on Monday for the next Real Investment Show.